China holds $3 trillion in US dollars and Treasury bonds. They can't dump it without destroying themselves. Or can they? Because right now, in 2025, they're doing exactly that quietly, systematically, and through a network you've never heard of. And when the selling accelerates, your mortgage rate, your credit card interest, and the price of everything you import will explode. This isn't a future threat. The trigger has already been pulled. Wars used to be fought with missiles, tanks, and soldiers. But in the 21st century, the most devastating weapon isn't nuclear. It's financial. And China just deployed it. Not with an announcement, not with a declaration, but through a shadow operation so sophisticated that most economists didn't notice until it was too late. They're selling US Treasury bonds, billions of dollars worth, every month through proxy countries like Belgium and Luxembourg. Countries that have no reason to hold massive US debt suddenly became the largest buyers and sellers in the world. Why? Because China is using them as financial fronts to quietly unload American debt without triggering panic. And here's what should terrify you. This isn't just about geopolitics. This is about your wallet. When China stops buying US bonds, the US government has to offer higher interest rates to attract other buyers. Higher treasury rates mean higher mortgage rates, higher car loan rates, higher credit card rates. Everything tied to the cost of borrowing explodes, and it's already happening. But the bond dump is only half the story, because China isn't just selling dollars. They're converting those dollars into something the US can't print: physical gold, thousands of tons, stored in vaults. While the dollar loses purchasing power, China is stockpiling the one asset that has held value for 5,000 years. This is the story of how financial warfare works in the modern era, how China weaponized America's own debt against it, and why the consequences are already hitting you. Welcome to Financial Detective, where we don't predict the future, we reveal the pattern. Your bank account, whether you realize it or not. Before we explain how China is pulling the trigger, you need to understand what the weapon actually is. US Treasury bonds. They sound boring. They sound safe. But they're the foundation of the entire global financial system. And they're the most powerful economic weapon ever created. Here's how it works. The US government spends more than it collects in taxes. Every year. The difference is the deficit. In 2024, the US ran a deficit of $1.8 trillion. To cover that gap, the Treasury Department issues bonds. These are IOUs. The government borrows money from investors and promises to pay it back with interest. Who buys these bonds? Everyone. Foreign governments, central banks, pension funds, mutual funds, insurance companies, and individual investors. As of 2025, the total US national debt is $36 trillion. And about $8 trillion of that is owned by foreign countries. The largest foreign holder used to be China. At their peak in 2013, China held $1.3 trillion in US Treasury bonds. Today, they hold around $775 billion officially. But here's the key word: officially. Because the real number is far larger, and it's hidden. Now, why did China buy so many US bonds in the first place? It wasn't charity, it was strategic. China runs a massive trade surplus with the United States. They export far more to America than they import. That means dollars flow into China constantly. Hundreds of billions per year. And China needed somewhere to park those dollars. They couldn't just let them sit. Inflation would erode the value, so they bought US Treasury bonds. Safe, liquid, and they paid interest. It was a perfect. China sold goods to America, earned dollars, and lent those dollars back to the US government by buying bonds. The US government used that money to fund deficits, which allowed Americans to keep buying Chinese goods. A closed loop. But there was always a trap hidden in this arrangement. China accumulated so much US debt that they couldn't sell it without crashing the market. If China dumped $1 trillion in bonds overnight, prices would collapse, yields would spike, and China's remaining holdings would lose massive value. It would be financial suicide. The US knew this. China knew this. And for years, it kept both sides locked in place. Mutually assured economic destruction. But that equilibrium just broke. In 2014, something strange started happening in global bond markets. Belgium, a small European country with a GDP of about $600 billion, suddenly became one of the largest holders of US Treasury bonds in the world. In early 2014, Belgium's Treasury holdings jumped from $150 billion to over $380 billion in a matter of months. That's a $230 billion increase. For a country that doesn't run a trade surplus with the US, doesn't have massive foreign reserves, and has no economic reason to suddenly buy that much American debt, this made no sense. unless Belgium wasn't the real buyer. Financial analysts immediately suspected what was happening. China was using Belgium as a proxy. Here's how it works. China wants to reduce its official holdings of US treasuries without triggering panic or political backlash. If China's treasury holdings drop too fast, it sends a signal to the market that they're losing confidence in the dollar. That could cause a sell-off, spiking yields, and crashing bond prices. So instead of selling directly, China routes the transactions through third-party countries. They use offshore financial centers like Belgium, Luxembourg, and Caribbean tax havens. These countries have sophisticated banking systems, minimal transparency requirements, and custodial accounts that allow foreign entities to buy and sell bonds without revealing the true owner. The mechanism is simple but effective. Chinese state banks hold accounts in Belgium. They sell US treasuries from their Chinese accounts and simultaneously buy the same bonds through their Belgian accounts. On paper, it looks like Belgium is accumulating US debt while China is reducing it. But in reality, the ownership never changed. It just moved through a shell. Why Belgium specifically? Because Belgium is home to Euroclear, one of the world's largest securities settlement systems. Euroclear processes trillions in transactions and holds assets for clients globally. It's the perfect infrastructure for disguising large-scale bond movements. And Belgium isn't alone. Luxembourg saw similar spikes, so did the Cayman Islands. These aren't coincidences. They're financial engineering. By 2015, analysts estimated that China controlled an additional $500 billion to $700 billion in US treasuries through proxies. That means their real exposure was closer to $2 trillion, not the $1.3 trillion shown in official data. And since 2015, this pattern has continued. China's official holdings have declined, but proxy holdings in Belgium, Luxembourg, and offshore centers have remained suspiciously high. The bond dump is happening. It's just invisible. China didn't start this shadow selling operation randomly. There's a strategic calculation behind it, and the trigger is Taiwan. Since 2018, US-China tensions have escalated. Trade wars, technology bans, military posturing in the South China Sea. But the flashpoint is Taiwan. China considers Taiwan a breakaway province. The US is committed to defending Taiwan militarily if China invades. This is a direct collision course, and China knows that if they move on Taiwan, the US will respond with the most devastating economic weapon in its arsenal: sanctions. Specifically, freezing China's dollar assets. This is what happened to Russia in 2022. When Russia invaded Ukraine, the US and its allies froze $300 billion in Russian central bank reserves. Overnight, Russia lost access to dollars, euros, and other foreign currency holdings. It was financial decapitation. China watched this closely, and they learned a critical lesson. Holding your wealth in an adversary's currency is a vulnerability. If the US can freeze Russian assets, they can freeze Chinese assets. And China holds trillions in dollars and dollar-denominated bonds. That's an existential risk. So China began preparing for the worst-case scenario. They started reducing their dollar exposure, diversifying their reserves, and converting dollars into assets the US can't freeze. Gold, commodities, strategic resources, and infrastructure investments through the Belt and Road Initiative. But they couldn't sell too fast. A rapid dump would crash the bond market, spike US interest rates, and trigger a global financial crisis. That would hurt China too. Their export economy depends on American consumers. If the US economy collapses, China's growth collapses. So they needed a controlled, gradual reduction. Sell quietly through proxies. Avoid triggering panic. And prepare for the day when the US financial system is no longer a safe place to store Chinese wealth. That day is coming, and the preparation is nearly complete. Now let's talk about what this means for you, because this isn't just a geopolitical chess game, it's a direct attack on your purchasing power. Here's the mechanism. When China sells US Treasury bonds, supply in the bond market increases. More sellers, fewer buyers. Basic economics. Prices fall. And when bond prices fall, yields rise. Yields are the interest rate the US government pays to borrow money. When yields go up, the government has to offer higher interest rates to attract buyers. And those higher rates ripple through the entire economy. The 1-0-year Treasury yield is the benchmark for almost every interest rate in America. Mortgage rates are priced off the 1-0-70-1-0-year Treasury plus a spread. So are car loans, corporate bonds, and credit card rates. When the 1-0-year yield rises, everything else rises with it. In 2020, during the pandemic, the 1-0-year Treasury yield was 0.5%. Mortgage rates were below 3%. By 2023, the 1-0-year yield hit 5%. mortgage rates jumped to 7%. That's a 4.5 percentage point swing in 3 years. And a huge part of that spike was driven by reduced foreign demand for US bonds. China, Japan, and other major holders stopped buying. In some months, they were net sellers. The result? The US government had to offer higher yields to attract buyers, and American borrowers paid the price. For a $400,000 mortgage, the difference between a 3% and a 7% interest rate is over $1,000 per month. Over the life of a 30-year loan, that's an additional $360,000 in interest payments. That's the cost of China's bond dump. It's not abstract. It's in your monthly payment, and it's going to get worse. Because China isn't done selling. They're just getting started. While China sells dollars, they're buying something else. Gold. Lots of it. Since 2015, China has been the world's largest gold buyer. The People's Bank of China officially reported adding over 300 tons of gold to its reserves between 2022 and 24 alone, but analysts believe the real number is far higher. China doesn't report all its gold purchases. They buy through state-owned banks, private entities, and offshore accounts. Independent estimates suggest China holds closer to 4,000 to 6,000 tons of gold compared to the 2,300 tons they officially report. Why gold? Because gold is the one asset that exists outside the dollar system. The US can freeze Chinese dollar accounts. They can sanction Chinese banks. They can cut China off from SWIFT, the global payment network. But they can't touch physical gold stored in Chinese vaults. Gold has been money for 5,000 years. It can't be printed, it can't be digitally confiscated. And in a world where financial warfare is the primary weapon, gold is the ultimate defense. China isn't the only one stockpiling. Russia has been buying gold aggressively since 2014. After the Crimea annexation and Western sanctions, Russia realized the dollar system was a weapon that could be used against them, so they diversified. By 2021, Russia's gold reserves exceeded their dollar reserves. When Russia was cut off from SWIFT in 2022, their gold holdings cushioned the blow. They could still trade with countries willing to accept gold or bypass the dollar system entirely. China learned from this, and they're building the same fortress. By converting dollars into gold, China is creating a reserve system that can't be sanctioned, can't be frozen, and can't be inflated away by the Federal Reserve. It's financial sovereignty, and it's a direct challenge to the dollar's dominance. China's bond dump and gold accumulation are part of a larger strategy, ending the dollar's role as the global reserve currency. For 50 years, the dollar has been the foundation of international trade. Oil, the most critical commodity on earth, is priced in dollars. This is the petrodollar system. If you want to buy oil, you need dollars. That creates constant demand for the dollar, which allows the US to print money, run deficits, and maintain its empire without immediate consequences. But in 2023, the petrodollar system began to crack. Saudi Arabia, America's oldest ally in the Middle East, announced it would accept yuan for oil sales to China. This was a seismic shift. For the first time since 1974, a major oil producer was willing to bypass the dollar. Why? Because China is now the world's largest oil importer. They buy more oil than the US, and they offered Saudi Arabia a deal. Accept yuan, and we'll buy more oil from you, instead of Iran or Russia. Saudi Arabia agreed. The floodgates opened. Now, other countries are following. Russia sells oil to China in yuan. Iran accepts yuan. The UAE is negotiating yuan-based trade deals. And China is building the infrastructure to make this work. They've established yuan clearing centers in London, Frankfurt, and Singapore. They've created the cross-border interbank payment system, SIPS, as an alternative to SWIFT. And they're backing the yuan with gold through the Shanghai Gold Exchange, which allows yuan to be converted into physical gold. This is the architecture of a post-dollar world. And it's being built right now. The US can't stop it with sanctions, because the countries involved are too large and too strategically important. China, Russia, Saudi Arabia, and Iran together represent a massive portion of global energy and manufacturing. If they trade outside the dollar's dominance erodes. And when that happens, the US loses the ability to print money without consequences. Inflation, currency devaluation, and loss of purchasing power become inevitable. Let's talk about where this is heading, because the pattern is clear and the math is inevitable. China is executing a multi-decade strategy to dethrone the dollar. Step one was accumulating dollars in Treasury bonds during the growth phase. Step 2 was using those dollars to build infrastructure, industry, and military power. Step 3 is divesting from dollars, converting reserves into gold and real assets, and creating alternative financial systems. Step 4 will be the collapse of the petrodollar and the end of dollar hegemony. We're in step 3 right now, and step 4 is closer than most people realize. Here's what the end game looks like. As China continues selling US bonds, Treasury yields keep rising. The US government's interest payments on the national debt explode. In 2024, the US paid over $1 trillion in interest on the debt. That's more than the defense budget. And as yields rise, that number will grow. Eventually, the US will face a choice: cut spending drastically, raise taxes to unsustainable levels, or print more money to cover the debt. All three options lead to economic pain. Cutting spending means recession. Raising taxes means slower growth. Printing money means inflation. Meanwhile, China and its allies build a parallel financial system. The yuan becomes a legitimate alternative for trade. Gold-backed currencies gain credibility, and the dollar's share of global reserves continues to decline. In 2000, the dollar accounted for 71% of global reserves. Today, it's 58% and falling. That decline accelerates as more countries lose faith in the dollar's stability. And when the dollar loses reserve status, the US loses the ability to export inflation. Right now, when the Federal Reserve prints money, the inflation is distributed globally because everyone uses dollars. But if the dollar is no longer the reserve currency, that inflation stays in America. Prices skyrocket, the standard of living collapses, and the empire that was built on financial dominance crumbles. This isn't abstract theory. It's already affecting your life, and it's going to get worse. Here's what happens next. First, interest rates stay elevated or go higher. Even if the Federal Reserve cuts rates, long-term Treasury yields are driven by supply and demand. And with China selling, demand is weak. That means mortgage rates, car loan rates, and credit card rates stay high. If you're trying to buy a house, you're paying $1,000 plus more per month than you would have in 2020. Second, inflation persists. As the dollar weakens, import prices rise. Electronics, clothing, cars, anything made overseas gets more expensive. The Federal Reserve can't fix this because it's not a demand problem, it's a currency problem. Third, your savings lose value. If you hold dollars, cash, or dollar-denominated assets, your purchasing power erodes. A 3% interest rate on a savings account doesn't help when inflation is 5% or higher. You're losing 2% per year in real terms. So what can you do? The same thing China is doing. Diversify out of dollars. Not completely, but strategically. Hold assets that can't be printed. Gold, silver, commodities, real estate. Hold assets that generate cash flow, dividend stocks, rental properties, businesses. And most importantly, understand that the rules are changing. The post-World War II financial order, where the dollar was supreme and US debt was considered risk-free, is ending. The countries that built wealth in that system are now dismantling it. And the people who don't adapt will pay the price. China holds $3 trillion in dollars. They can't dump it all without destroying themselves. But they don't have to. They just have to sell enough to raise US borrowing costs, weaken the dollar, and accelerate the transition to a new financial order. And that's exactly what they're doing. Through Belgium, Luxembourg, and offshore networks, they're quietly liquidating US debt. Through gold purchases, they're building a reserve system outside the dollar. And through yuan-based trade agreements, they're creating the infrastructure for a post-dollar world. The trigger has been pulled, the weapon has been fired, and the impact is already being felt in mortgage rates, inflation, and the cost of living. The question isn't whether this will happen. It's already happening. The question is whether you're prepared for what comes next. If this changed how you see the dollar, the debt, and the financial system, subscribe. Because the architecture of power is shifting, and most people won't understand what happened until it's too late. The answers aren't hiding in the news. They're in the mechanisms, the patterns, and the money flows. And I'll show you where to look. One question for the comments: do you think the dollar can survive as the reserve currency for another 20 years? Or is the collapse inevitable? Let me know below.